As usual, now what we say should be taken as financial advice. What we say is purely educational, and also we do own some shares mentioned on the slides. According to experts, in 2023, there's a 60 to 90% chance of recession, and I'm sure you want to avoid that. Now, over the past 7 months, our FIRL Pro model portfolio has grown by 18%, while the market has fallen by 3%. Now, if you're interested in learning how we did it, we've got a special free training just for you on the 23rd of March. So go ahead and sign up in the comment section or the description. All right, so today we will be reviewing AmTotal Return Fund. This data is until December.
Yes.
Last year, and you know, when I looked at this, I thought, well, is this FD-like returns with a lot more volatility? I mean, this is straight out of their fact sheet, and it does look that way, although they were outperforming by quite a big margin. I'm going to eyeball and guess it's in the 2010 period, right? Roughly, or maybe it's a bit later. So they used to outperform. They were as high as maybe 130, 140, 150%, while the FD rate would have yielded you roughly 50%.
Yes.
So that is roughly 100% outperformance. But unfortunately, it has not, maintained its lead. And it's still a hit. But certainly, if a person is investing in a fund, they don't just want to beat FD by a small margin. That said, right, it's not a knock on the fund. I think what is important for us is to figure out why that has happened and see what lessons we can learn out of this fund.
Yes.
I know in the past we have sort of only reviewed funds that have done really well. So you can see this Aminvest one is not as good. But that doesn't mean that we cannot learn anything. So, Jonathan.
Yeah, so actually one thing that surprised me is that I don't know why they didn't compare themselves against the KLCI index instead of the FD, because of later I'm going to show you why am I actually saying this. This has to do with their stocks. Okay, so this is if you want to have a look at their annual return wise, and also if you want to look at the longer period, which is your 1 year, 3 year, 5 years, and 10 years, you can see that their returns against the Maybank's fixed deposit return plus the 3% spread, it's okay, decent, but in 10 years span, it is about the same.
All right.
Yeah, so it's about like 4%-ish, your FD rates, basically. Yeah, and if you look at 2021, they are actually not performing well. Yeah, I think because there's a market crash.
Okay.
Yeah, I think there's a correction, and also the companies that they own also is not like resilient to these kind of crashes. But if you look at 2020, it has been outperforming by a huge margin. Right. Yeah, so that is actually pretty impressive. But yeah, we shall see what assets do they hold. So you can see that about 29% is actually coming from financials. So financials is basically your banks, yeah, your Maybanks, your public bank, and all those financial institutions. And then 14% is cash.
So about 35% is in these two sectors.
Yes, it's basically cash. You're holding cash.
In a way, yeah. And we'll explain to you why financials is a little bit like holding cash later on, but yeah.
Yep. And then the remaining 19% it is tech. Then the remaining one is like just a jumble of different industries. Okay, so this is the top 10 best performing stocks that they own. So you notice that none of it is actually related to financial services. It's all banks. So there's only one, which is the top 2. Or actually there's top 3. But the number 1 is actually coming from Saipak.
Which is quite recent, right?
Yeah. This the reason why also is I believe they managed to board it at the bottom. Yeah, I'm not sure what's the timeline, but if you can see that they are making about 2x already, which means they definitely have caught up in the bottom before it actually rallies. And then another one is an interesting company that we actually got talk about it, but it's something that we're just putting in our watch list only, which is Focus Point Holding. I believe this is a spectacle company.
Yes, they also do
bakery.
Komugi.
Yeah, correct.
Komugi, yes.
Yes, exactly. And then Timecom is over there. Then the rest is all banks and TMs.
I mean, you can see some of the companies that we have done videos on SciPark. Go check it out here.
Yes.
But I think that outside of SciPark, some of the companies are pretty solid. We're not saying that SciPark isn't solid, but we're saying compared to these other names, certainly SciPark is in a different phase, right, as a company. Of course, I am a long-time shareholder of Time.com. Right, Time.com is personally one of my best investments as well. I mean, it's run by a fantastic owner with a fantastic business model. It is the one GLC that doesn't behave like a GLC.
Yeah.
Right. Last week or in the previous video, we talked about Pharma Niaga and how they have this national service thing going on, right? Where, profits are secondary.
Yes.
And someone in the comments actually said that, then why bother covering GLCs when they have this issue? And my answer to that is that because not all GLCs behave the same. And so Time.com is a bit different. And even then, I would say, even if profit is secondary, some companies like TM, for example, was an investment that I made, I believe, after the 2018 elections. And I did well because it was punished, in my opinion, at that point in time, quite unfairly. So TM time, they're a bit different. I know I'm not a bank investor, but CIMB is apparently the Goldman Sachs of Malaysia. So they have that going for them. And of course, QR Resources, Public Bank, these are like, legendary.
It's going to be there.
These are legendary, yeah.
It's going to be there for years. Unless there's like a consolidation happens. But we shall see.
Now, guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it.
Okay, so this is the top 10 worst performing companies. So you can see, there's a very well-known name over here.
Yeah.
Revenue Group Berhad, which also I think a few fund managers also kind of own this, and then it's in their top 10 worst performing stock. But you notice also there's a few more well-known companies, MyEG, CMSB. This one is related to Sarawak. About the development of Sarawak. So they are handling, they have the monopoly actually over there. In one of the, I cannot remember what building material is that, or is it the sand or something? Yeah, and then there's Dagangan Exchange, DNEX, and Gtronic. And UWC, I think they bought it at the top. They kind of have more insights. So yeah, that's...
Yeah, you can see like some are in the construction sector. I completely forgot what JHM does already. So apologies.
Yeah.
It's a name I'm definitely like aware of.
Yeah, same.
So like Gtronic is
your memory.
It's actually I call it the sweatshop, a sweatshop for iPhones sensors. They may not like it, but they never admit that it's iPhone, but if you dig hard enough, you know. DNEX, obviously difficult kind of business model because of the capital involved, and of course whatever is happening that probably costs a bit revenue, we know, right? And but the rest I can't really confirm. So I don't know if this is a weird thing to say, but I would like to say that if there are a lot of companies that I'm not familiar with and Malaysia is not a big market, there's a good chance that they're not performing well. I don't know if that's a cocky thing to say, but I mean it genuinely, because a lot of these companies in this field are fields or industry that I would avoid, like financials, like construction. And even in the field that we are interested in, like semiconductor manufacturing, some of the names that we have either avoided or we are on like, we're 50-50 on, like DNEX, not quite there. Things like that. So anyway, yes, moving on.
Yeah, so that's the top 10 best and worst. And now we shall look at the invested companies that they have invested. So they have about 52 companies in total that they held. And the most money that they park in is Maybank. obviously, and then followed by a few other blue chip stocks. So that's your TMB, Public Bank, CMB, Genting.
MIC is there as well.
Yes, MIC
that probably gave them quite a good return, no? Oh no, they're losing money.
Yeah. Right now they're losing money by a bit lah. I don't think it's a lot.
Right, it looks like a 5%. Yeah.
Yes, exactly.
My eyeball, yeah.
And then let me see. Yeah, I mean the top. If you look at the top 10, it's more everything's inside the KLCI.
Right.
If you pay attention. Yeah. Exactly. So actually their benchmark should be against, that's the reason why I actually say that why they are not putting their benchmark against KLCI, because the top 10 or maybe even top 30 holdings is all listed over there.
Right.
Instead of the 3% deposit Maybank.
Okay.
Yeah. I mean, that's a more relevant benchmark lah, but I don't know. Maybe they are comfortable with just comparing it with the fixed D. But yeah, anyways, you can just check it out over here. They didn't really invest a lot in tech. This one is a very conservative fund. A lot of bank stocks, a lot of those big names, big corporations, big MNCs company. Yeah, I think.
Right.
Yeah, no comment. Any more comments?
They are one of the more diversified ones. They outside financials, they are pretty even across the board, and because they are quite heavy into financials, and financials are in the Malaysian context quite a low return sector, and you add in the fact that they have 15% cash, it means that I wouldn't say they made their life harder to generate returns, but I would say that their strategy means that other sectors have to work a lot harder.
Right.
I'll put it that way.
Right. I believe this fund, right, is like, if you don't want to park your money in FD, you can park your money in Aminvest.
Yeah, it's higher than FD anyway.
Yeah.
So 3% average. They are, in a way, they are quite fortunate that Bank Negara never increased the OPR. Just like how the US Federal Reserve is increasing it, like the level of aggression of increasing. And yeah, because if that happened, then they will not be outperforming the fixed deposit.
Right. Okay, so this is the position sizing.
Okay, so this is a bit surprising.
Yes, so 9% is Maybank. Let's just like calculate 60%, 21, 26. So about 30%. Out of the 6 stocks, 50% is banks.
Yeah.
Then the rest is all this your normal GLs, MNCs, big MNCs company. Yeah.
So probability wise, right, if your portfolio skews a lot in favor of large cap companies, almost by definition, you will not lose a lot of money, but by definition also, you will not make a lot of money, right? Malaysia has a slightly different dynamic to the US, where in the US, the probability of a very large company becoming even larger is higher than Malaysia.
Yes.
Mostly because companies that grow very, very big in Malaysia tend to dominate the Malaysian market. So whether it's like Maybank, Public Bank, Tenaga, but they can't really go offshore. And companies that can go offshore tend to be a lot smaller. In Malaysia's case, right, if you look at funds or even your own personal investment that has done well, they're most likely going to be in a lot smaller cap sort of situations. If
you want to have like a multi-bagger returns, those are the range that you want to like flip your stones and just find
so there's this concept called mean reversion, right? Like things that are big either won't stay big for long, or they will just stay at that size for a long time.
Yes.
Similarly, companies that are small, probability of them becoming big is a lot higher. And there's a saying, right, like going from 3 million to 30 million in sales is a lot easier than like 30 million to 300 million. But, and of course, 300 million to 3 billion. So that's the whole concept behind this, and why probably they've not like outpaced FD by a huge amount. Maybe that's by design, right? We don't know. Maybe that's what the fund manager wants.
Yeah, maybe. But to those that actually invested in this type of fund, it's pretty interesting.
Yeah.
It's very interesting.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, so this is the final takeaway. They have 51 stocks. They are more heavily towards financial service. They're skewed towards that industry. And then they place a lot of bet on Tenaga. However, it is making a loss, which is about 16%. As of the February 2023's recording. And yeah, I did mention this KLCI index because it's basically just KLCI index fund. Yeah.
I think the challenge with this, and I don't think I have much to add on the portfolio, but I think I've explained. But I think as a unit trust holder, suppose you were a unit trust holder, or you're thinking of getting into the fund, the question is, have they generated not just returns that are above FD, but it needs to be higher than the fees that they're going to charge as well.
Yes.
Right? Because if you buy a fund, usually you are buying it through an intermediary, right? An agent, let's say. That's going to give you a sales charge of anywhere, depending on the fund, between 2 to 5.5%. So that's one hurdle. The second hurdle is the management fees. I'm not sure if you checked what the management fees are, but they are probably, if I'm going to guess, anywhere between 1 to 2%. And that means they need to, in my estimation, they need to at least double the FD rates in terms of return for you to match FD returns. Okay, let me repeat. They need to have twice the returns of FD for you,
to make
Mr. Unit Trust holder, to match FD returns. Because even if they announce to you that they made like 5% or 6%, which is twice of FD, you have to pay that 2 to 3% over to them.
Yeah. And it's annually, right?
For the management, yes. And if you are DCAing, meaning you're putting in money every month, then it's a 5% charge every year. So you need to make what? Let's say the maximum 2 plus 5.5, so 7.5%. At the low end, maybe let's say 1% plus 2%, so 3%, right? So yeah, like at least they need to make 60%. And if your agent takes a big fee and the management fee is a lot higher, then you need to be making about nearly 11%.
Yeah, which is quite difficult if all of your companies are holding in the KLCI.
Which is quite difficult.
Yes. Okay, but you know what's not so difficult to make more returns? FIRL Pro.
Yeah.
So yeah, in FIRL Pro, we actually managed to make about double digits. I believe so it's around 18 to 20%. Yeah, and these are the companies that we hold. Only one stock is in the red. I believe even at these market conditions, our portfolio is still quite resilient.
Yes.
Yeah, because we managed to scope it up at the bottom. Pretty lucky.
Yes. And these reports, this is actually a very new update for FIRL Pro. Our older reports tend to be a lot more proper in terms of like grammar and all that. And it takes maybe 10 to 15 minutes to read. Recent changes now means that we only do like 1 or 2 pages very, very quickly. So it's even faster now. You get some of the salient and important information to help speed your decisions up when it comes to investing. And as I mentioned earlier on, a lot of the returns in the Malaysian stock market is in the small cap to mid cap space. The majority of stocks that you can see here, from stock A to stock O, are in that, call it sub 750 million, sub 1 billion market cap range, because that's again where we think you're the best chance of generating. Because now with that also comes a different skill set. With that also comes a little bit more uncertainty, but that's why we have the program, right? Is to help create safer environment on the kind of stocks that can be in your universe of attention, and also the risk and portfolio management techniques that we share in the FIRL Pro program and in our Telegram group chats and all that.
Yes.
To again help skew the probability of you succeeding in the stock market much, much more in your favor.
Yes.
Now, if you're not like super convinced, or rather you want to know more, you can check out our free samples. We give two free reports actually, one on a stock, another one which is a more big picture, more macroeconomic stuff. And if you want even more details, you can send us an email. You can DM us on Instagram. You can leave a comment in the YouTube section.
Or you can just check out our sample
Yes,
sample.
our preference for email because it's a lot easier to communicate there, but pick whatever you want to do.
Exactly. Other than the free sample, I'm not sure whether you guys realize that we're also going to be having a big masterclass.
Yes, that's right. Looking forward to seeing you guys there.
Yes, which is how to profit from the 2023 recession. Basically there, we're going to be showing you how we actually pick stocks for FIRL Pro.
Yes.
So if you are interested in that, make sure to check out the links in the comments and description.
Yeah.
And with that said, I think we're going to be seeing you in the next video.
Yes. See you.